Walk into any dealership right now. Just walk in and pay attention to what you feel. Something is off. Cars sitting on the lot longer than they should. Salespeople coming at you faster than before. Discounts showing up before you even ask. And a general energy that feels desperate. Like they need you more than you need them. And here's the thing. That feeling is not in your head. Because what's happening in the car market right now is something most people aren't talking about openly. Headlines will tell you demand is strong. Analysts will say the industry is recovering, but if you look at the actual numbers, the inventory levels, the incentive spending, the days on lot data, a very different story starts to emerge. This is a silent correction, and it's already underway. So today we're going to break it down. 13 car brands that are feeling serious pressure right now. Brands that are sitting on too much stock, spending too much on incentives, and quietly lowering prices just to keep units moving. And we're going to talk about what that actually means for the market and for you as a buyer. Let's get into it. First, let's understand something fundamental, because it reframes everything that comes after. When a product sells well, it doesn't need discounts. Think about it. When demand is strong and supply is tight, brands don't offer cash back. They don't run 0% financing for 72 months. They don't knock $5,000 off the sticker before you say a word. They don't have to. So when you start seeing those things, big incentives, aggressive promotions, dealer markdowns, what you're actually seeing is pressure. Pressure to move units. Pressure to clear inventory. Pressure to fix a problem that isn't being talked about publicly. Discounts are not generosity. They are a signal. And right now, that signal is flashing across 13 different brands in ways that should get your attention. Let's start at number 13. Mitsubishi. Mitsubishi has been quietly fading for years, and the current market conditions are making it more visible. The lineup is limited. Brand recognition is weak compared to competitors. And fewer buyers are walking into Mitsubishi showrooms with real intent to purchase. To compensate, incentives have been climbing. But here's the problem with that strategy. Discounts don't rebuild brand desire. They just make the underlying weakness more obvious. When you have to pay people to consider your product, you don't have a pricing problem. You have a relevance problem. Number 12. Ram. Ram built its reputation on tough, capable trucks. And for a while, that worked really well. But truck prices have climbed significantly over the past few years, and buyers are starting to push back. The days of selling full-size pickups at $50,000, $60,000, $70,000 without hesitation are getting harder. Inventory is building, incentives are rising, and the gap between what Ram wants to charge and what the market is willing to pay is becoming more visible every quarter. Number 11. Volkswagen. VW made a big bet on electric vehicles, and strategically that made sense. But the reality of EV adoption is messier than the projection suggested. Demand is uneven. Some markets are moving fast, others are stalling. And when you've committed production capacity to a segment that isn't absorbing it fast enough, inventory builds. The result? Discounts, incentives, pricing adjustments. VW is managing a gap between where it expected the market to be and where it actually is. Number 10. Alfa Romeo. Alfa has something most brands struggle to manufacture: genuine identity. The cars are distinctive. The brand has character. But character doesn't automatically translate into sales volume, especially when your pricing sits at a level that buyers compare directly against more established luxury names. Low volume and high pricing is a difficult combination when demand softens. And right now, pricing is softening to compensate for cars that aren't moving at full sticker. Number 9. Lincoln. Lincoln is caught in a positioning problem that's genuinely difficult to solve. It's not quite a full luxury brand. It doesn't have the heritage or the cachet of a Mercedes or BMW, but it's also not a mainstream brand anymore. It sits in between, and that in-between space is a tough place to be when buyers are making decisions. When your positioning isn't crystal clear, buyers hesitate. And when buyers hesitate, inventory builds and incentives go up to close the gap. Number 8. Jaguar. Jaguar is in the middle of a major transformation. The brand is cutting models, changing direction, and trying to reposition itself as a high-end electric luxury name. That kind of transition takes time, and during that time, demand becomes uncertain. Existing buyers aren't sure what Jaguar is becoming. New buyers are waiting to see, and that uncertainty shows up directly in the discount data. Number 7. Maserati. Even the luxury segment isn't immune. Maserati is facing slower demand, and when high-end buyers start to hesitate, when they decide to wait or choose something else or simply hold on to their current car longer, or inventory becomes a real liability at that price point. You can't just slash prices on a Maserati without damaging the brand, but you also can't let cars sit. So pricing adjusts carefully and quietly, but it adjusts. Number 6. Nissan. Nissan moves a lot of cars, but if you look at how they move them, the picture is less impressive. Incentives are consistently high. Discounts are built into the expectation. The lineup has aged in key segments without significant updates. The problem with running on heavy incentives for too long is that it creates a cycle. Buyers start to expect the discount, residual values drop, and the brand's ability to charge full price, real full price, erodes over time. Nissan has been in that cycle, and right now the margins are showing the strain. Number 5. Infiniti. Infiniti has an identity problem that's been building for years. It sits in the premium space, but it hasn't managed to fully break through to the level where buyers choose it on brand strength alone. It's not quite where Lexus is. It's not quite where BMW or Audi are. When a brand occupies that uncertain middle ground, buyers hesitate to pay full premium prices, and hesitation leads directly to incentive spending to close deals. Number 4. Chrysler. Chrysler's lineup is remarkably thin at this point. Few models, limited visibility in showrooms, and demand that has been declining steadily. For a brand that was once a major force in American automotive, the current footprint is a fraction of what it used to be. To move the inventory they do have, discounts have become essential, not occasional. Essential. That's a significant shift in how a brand operates, and it signals deeper, structural issues. Number 3. Genesis. Genesis grew fast, really fast. It came out of nowhere, built momentum, won awards, and started taking real market share in the luxury segment. But fast growth has a way of plateauing, and Genesis is hitting that wall. Competition is intensifying, established luxury brands are responding, and buyers who were curious and early to the brand are now being courted hard by everyone. More choices means more aggressive incentives to close deals. Number 2. Jeep. Jeep expanded aggressively. New models, new segments, higher prices. And for a while, the brand had enough cultural momentum to support that expansion. But demand didn't keep pace with production. Inventory started building on lots, and the gap between supply and demand became hard to ignore. The result has been significant incentive spending, discounts that wouldn't have existed a few years ago, and pricing adjustments that tell a clear story about where the market actually is versus where Jeep hoped it would be. And number 1, Cadillac. Cadillac is pushing hard into the premium space. Higher prices, more sophisticated positioning, a genuine attempt to compete with European luxury at the top of the market. And in some ways, the product is there, but the market is resisting. Buyers at that price point are loyal to established names. They know what a Mercedes represents, what a BMW delivers. Convincing them to choose Cadillac at similar or higher prices requires more than just good cars. It requires trust that takes years to build. And when that resistance shows up, discounts follow. Even at the top of the market, even on cars positioned as premium. Because inventory doesn't care about brand ambition. So what's the pattern here? 13 brands. Different strategies, different segments, different histories. Same result. Too much supply, not enough demand, rising incentives, falling pricing power. And here's the important part. When that pattern shows up across this many brands simultaneously, it's not a coincidence. It's systemic. It reflects something real happening in the broader market. Production kept running at a pace that assumed demand would stay elevated. Demand didn't. And now the mismatch is working its way through the system in the form of discounts, incentives, and softening prices. Now, what does this actually mean for you? If you're a buyer, this is a shift in power. Real, meaningful power. More inventory means more negotiation room. More brands competing for your attention means more flexibility from dealers. Cars that are sitting on lots longer means salespeople who are motivated to make a deal. This is the kind of environment where patient buyers win, where doing your research pays off, where walking away from one dealer and going to the next one actually works as a strategy because they need to move that car. The leverage has shifted, and if you understand that, you can use it. Here's the honest takeaway. The market isn't collapsing. Let's be clear about that. But it is resetting. Quietly. Gradually. And those resets always create a window. A period of time where the conditions favor the buyer in ways that don't last forever. Eventually, production adjusts. Inventory normalizes. Incentive spending comes back down, and the window closes. But right now, that window is open. 13 brands are under pressure. Discounts are real. Inventory is sitting. And the buyers who understand what's actually happening, who recognize the signal behind the discount, who see the pattern behind the pressure, those are the ones who come out of this market in a genuinely strong position. The only question is whether you're paying attention. Because the reset has already started, and what you do with that information is entirely up to you.